Welcome to Drill Down Earnings. We have quarterly results out from Tesla. It's one of the 50 most important companies in technology. We all knew that. This is the business story behind one stock in the move. And I'm Cory Johnson, Chief Market Strategist for Epistrophy Capital Research. And we want to talk a lot more about the stock, whether this is a beat or a miss. Such an important company, Tesla, one that has captured the world's attention, to be sure. These numbers were worse than Wall Street expected. Revenues just a little bit worse, earnings per share notably worse. But I want to take you beyond the beat or the miss and actually look at what the business did, the actual numbers. So this business is shrinking. This business is not doing great. A 12% decline in revenues on an overall basis here to $22.5 billion in revenues here. They had $900 million in GAAP operating income, net income of $1.2 billion, which is to say that they borrowed a lot of money and they made some money in interest. They made some money in interest based on the cash and the way that they've spent their money and put their money to work here. But, and as I mentioned, their non-GAAP numbers, I don't really care about non-GAAP numbers because I really want to know what the generally accepted accounting principles tell us, as well as operating free cash flow of $2.5 billion and free cash flow of only $100 million. So let's dig into this a little bit deeper here. So margins are slipping. Margins are now down to 4% operating profit margins for this company, way down from the 11% they were 2.5 years ago. Now, they're in lots of businesses. They're in the solar business. They're in the battery business. Of course, they service their cars as well. And that's now 14% of revenues. But 74% of revenues are car sales, automotive sales, and automotive sales are tanking. Automotive sales are down 16% on a year-over-year basis. It's a consistent decline we've seen from this company. And they were buoyed for a while by their energy generation and battery business. Well, that business is now slipping down 7% on a year-over-year basis. And so while the other businesses are largely insignificant compared to auto sales, they're not helping when they need the help right now. The most important story, and I've been talking about this for years, is the zero emission vehicle credits. That is to say that when other car makers in the US and California in particular, when the other car makers are making cars that pollute a lot, that have low miles per gallon, depending on how bad that mileage is, they can pay up or they in order to get a credit against it, so they don't have to pay as much in taxes and fees. And so Tesla, by making cars that don't require any gas at all, are able to create these emission credits, these certificates that they then sell to the other automakers. And that has been a substantial portion of their business in the last few years. In fact, when you think about it, a zero emission credit doesn't have any cost associated with it. You don't have to, you make a car to sell a car, which is what Tesla does, but they get the bonus of having this other business of creating these credits. Well, those credits have been stripped from the law thanks to President Trump and the One Beautiful Bill Act, now a law. I won't take you through Schoolhouse Rock here, but Tesla has been on the dole. Tesla has received billions of dollars of value just from these zero emission vehicle credits, the ZEV credits here. And there's lots of ways to look at this. They fold it into automotive revenues, but it's not really automotive revenues. I don't think so. I mean, that's the way they account for it. They didn't even used to break it out. But look, it was 24% of free cash flow, down from the 90% it was last quarter, but still a lot of free cash flow. The company's on the dole. If you think about it from a gross margin standpoint, right? Like what kind of a profit the company gets from selling a vehicle, but you take away that zero cost, zero emission credit, well, their margins go from 17% to 15%. Automotive margins much worse. Again, as I mentioned, in terms of free cash flow, it was a substantial amount of free cash flow. Heck, in September quarter a year ago, it was all of the free cash flow were these zero emission credits, which are going away, which is a problem for Tesla, whose sales are shrinking. So when the number came out, the stock rallied, it sold off, it's kind of flat into the conference call. In the short term, this stock is not a weighing machine of the value and success of the business. It's a voting machine based on what the market and people want to trade this thing into. And indeed, in the last year, while sales have been falling, Tesla shares have been up 35% for the year. But again, there's this narrative out there that says EV sales are down, people don't want EVs, and it's hurting Tesla. It's not true. EV sales are up. More EVs were sold this last quarter than the previous year in America. EV sales have been up double digits, now single digits. Tesla's sales are shrinking. EV sales are increasing. So EV sales only growing at 4% now for the rest of the US market. But for Tesla, EV sales on a unit basis are down 17%. That's according to Cox Automotive Kelley Blue Book numbers from the last quarter. So Tesla shrinking, EV sales increasing. That's not good news for Tesla. And that's, of course, not the story they want to tell at Tesla. In this conference call and in their press release, they're talking about robo-taxis, robots, AI. They don't want to focus on cars because the story is not pretty. Here's CEO Elon Musk.
There's a lot of exciting things happening in the design studio. It's not like static. And really what's going to happen over the next several years is a fundamental transformation of the company from a pre-autonomy world to a post-autonomy. And I'm working on a new master plan to articulate that Tesla team. And there will be some teething pains as you transition from pre-autonomy to a post-autonomy world. But I think the future vision for Tesla is incredibly exciting and will profoundly change the world in a good way. May sound like painful or whatever, but I think let's just say if we execute on that plan effectively, which is you have to actually do that, Tesla will be the most valuable company in the world by far.
Elon being Elon, there's nothing like it. All right, but what's it all mean? What's your big drill on earnings takeaway? What's the one thing you want to remember about these second quarter Tesla results? Well, Tesla's second quarter earnings, the big takeaway, the essential summary or drilled on earnings takeaway is that the sales are stuck in neutral. Sales are down 12%, revenue's down 12% on a year-over-year basis. So despite an operating income and some net income and some free cash flow, a lot of it comes from these credits coming from the federal government that are going away with this new One Big Beautiful Bill Act law. That's it, a One Big Beautiful Bill Act bill. And now it's a law, and it's going to take away these zero-emission vehicle credits, which have accounted for sometimes all of Tesla's free cash flow. And the one number that tells you a whole lot is 41%. 41% of the profits of the net income from this company in the last 12 months have come from zero-emission credits, and that's going away for Tesla. Not good news for Tesla. All right, thanks for checking out Drill Down Earnings. Subscribe to us. Hit me up on at Cory TV on X. Also connected to Elon Musk, as well as all the socials, Instagram, TikTok, YouTube, at Drill Down Pod.